Welcome back. We are now in chapter 12, and in this chapter, we will be taking a case study of a new project, and we'll be assessing the term loan requirement of this company, right? So this will be one of the four chapters. We'll be discussing the case studies. Okay. So this will be companies with bank data, right? Because we want to incorporate all possible aspects we discussed in the previous chapter. So basically, right, if you're given any proposal, uh, your proposal will be falling into one of these four categories. Okay. So when you get a proposal, like these are the four things that you need to. These are the four things that you need to do. Okay. First, for the existing financials, say for example, we're in 2013, and the company has got actual data for 2011, 12, 13, the past years. Say. So then, first of all, you have to analyze the financial portion of the company, the existing financial portion of the company, taking the financials of the latest year and the last 2 years. Okay, so 3 years actual data you have to take, or 3 or 5, depending on the bank policy. Okay, then you have to take the projections, that's the same data, right, to assess the working capital requirement of the company. And if the company also requests for term loan, then you have to assess the term loan separately. So these are the various things that you need to do for a proposal. Okay, so what we will do is we'll first of all take 4 case studies. In the first case study, we will focus on a term loan. This in the first case it will be a proposal for a term loan. Okay, so this will be a new company with no past financials. So when you are given such sort of a proposal with a company with no past data, it's a new company. So how are you going to assess the term loan? What are the aspects to look into in those sort of proposals? That will be the first case study. Then we'll be taking a company that is already sanctioned a term loan in the past. Now the company doesn't want a term loan. Maybe it is approached for some working capital limit. So in those sort of proposals, what you need to look at when 1 year or 2 years after the sanction of term loan, the company has come back to us, and we now have the financials of the company. So what are the aspects to be looked into those sort of proposals? Okay, so that will be one more case study. Then we'll take a example of a company which has approached the bank for enhancement of working capital limit. So if a company has approached for working capital limit enhancement, it will submit CMA for the next 2 years. For the next 2 years, it will submit CMA. Existing 3 years analysis you have to do first of all in this case, and then you have to also take the projections and assess the working capital limit. So that will be one more case that we will be doing. We'll be assessing the working capital enhancement. Okay, and under working capital enhancement, we'll also take a example of a company which is where the assessment is done in the cash budget, because for seasonal activities and certain types of activities we will follow the cash budget method of assessment. Okay, so in this chapter we'll be taking the example of a new company, okay, which has got no past financials. This is for a new project. Okay, so in those sort of situations, what are the aspects you need to look into? So for this example, we'll take the example of a company called PQR. Okay, so let's look at the brief details of this company. Okay, so this PQR is a new company. Okay, as a new company, so we don't have any past financials, and this is a company that is setting up an aluminium manufacturing unit in a village located 100 kilometers from Bhubaneswar in Orissa. Okay, so the installed capacity is given is around 26,000 MT per year, and this company has got registered office at Bangalore, because its promoters hail from Bangalore. Okay, so the company is promoted by 2 women. We're given the names of the promoters, and that they come from an entrepreneur family. And the husband of one of the promoters is a first generation entrepreneur and experienced in various businesses. Okay, so he has got experience in other sectors such as real estate, mining, transportation, and trading of metals. Okay, we also given that his son, right, he's a technocrat and holds a degree in. Right, his educational background is furnished to us. Okay, we're also told that the company has got group accounts. Okay, so this family has got interest in 2 other companies, Deccan Minerals and Modern City Realtors. We're given the details of these 2 companies. Right, Deccan Minerals is engaged in trading of metals, not aluminum alone. Right, is general company engaged in trading of various metals, including aluminum, steel, and zinc. So it's a 25 crores company existing for past 10 years. Its banker is PNB, and it's availing 5 crores working capital limit from PNB. Okay, and it's recently added a manufacturing facility also. Okay, so one more group company is the Modern City Realtors, is a real estate developer. So far 3 ventures have been floated. So far the company has done 3 ventures. Okay, 2 more ventures are now presently in the implementation. The banker of this company is Bank of Baroda, right? And we're also given that both these companies, group companies, are standard accounts. Okay, So now for this particular project we are told that the company is availing the services of a technical consultancy firm called Techno-art. Okay, so there's also a TV report that all the company has also prepared TV report from one of the industrial consultants. Has also given some details of the technical in charge of this project. Okay, so the raw material is proposed to be sourced from Orissa and Chhattisgarh. A finished product is basically being targeted at the southern market of India. So the project implementation, the project is already under progress, maybe just started. Promoters have so far spent 2 crores from their own resources. And DCCO, the commercial operations are expected from July 13. There are some statutory approvals that are pending, right? Some are pending. And also we told about some collateral security. The company is offering 10 crores and all the directors will stand as guarantors for this limit. So the total project cost they have estimated as around 55 crores, which is to be around 55 to be financed by 20 from own sources of the promoters and 35 from the bank. Working capital limit also 10 crores is requested. Okay, so this is the broad outline of the proposal. So whenever you come across a term loan appraisal, right, the first thing that you need to do is to go through what is known as the information memorandum, right, also known as DPR, commonly known as project report. So a company that is applying for a term loan will be submitting a project report. Now your first job of credit officer is to go through this information memorandum or project reports, because this is the basic document, right? This is the basic document and will give you the most basic information. Everything that you need to the basic information will be required, containing information on all aspects of this project, right? What is this project all about? What is the background? The promoters the project cost, the location of this company, the technical details such as the manufacturing process, all aspects of this project will be discussed in the information memorandum. Okay, some banks usually have a cutoff for submission of this project report. So once you have gone through the project report, so you'll get a bird's eye view of the project as a whole. So then now we'll discuss point by point, right? What are the aspects that you need to look into a term loan proposal? Okay, the first important point is the credentials and track record of the promoters. Okay, so in this example, we are told that the promoters have new connection to the bank. Okay, so these are not existing borrowers to the company. These are not existing borrowers to the bank. There are new connection, and the bank doesn't know anything about this promoter. So what is known as due diligence has to be conducted. A balance sheet analysis and credit appraisal for bankers. Please refer to chapter 16 where we have a chapter called credit concepts. There will be having a detailed discussion on points such as credit investigation, due diligence, right? So when a new borrower approaches the bank for sanction of limits, what are the various points to be looked into, right? All this comes in the ambit of what is known as credit investigation. So every bank will be having what is known as credit investigation. You call it by various names. For large companies, you'll have something called due diligence. Basically, it's about investigating the background of the promoters, right, the integrity, the capacity to run the company, right? What is the market opinion? Independent inquiries. Basically, it's field level investigation. So especially this is for new company, you need to do the credit investigation. The format will be based on the individual bank, but basically it's about assessing the credit worthiness and the whether the borrowers are of honest reputation, right? And what is the market opinion about this company? Okay, so let us assume the findings of the due diligence for this company is satisfactory. So one way of assessing about the promoters' business acumen is to look at how they are running the existing companies, right? This group has got two group companies. Okay, the promoters already have two companies, Deccan Minerals and Modern City Realty. So one way of assessing the business acumen of the promoters is to look at the how the existing group companies are performing. So for this, you can call for the balance sheet of the last 3 years of these companies and assess the financial portion. You can also talk to the bankers, right? You can also talk to the bankers and get the what is known as the credit opinion report, also known as the PNC report. Okay, the credit opinion report will be discussing whether how the dealing of these two companies are, right? So this is a requirement from the RBI. So whenever there will be a format called PNC report, okay, you can call for the credit opinion report from the bankers of this company. So these group companies are banking with PNB and Bank of Baroda, so you can call for credit opinion report of the bankers. What is the dealings of these companies? Okay, and also one of the companies is undertaking an expansion project. Okay, Deccan Minerals is undertaking an expansion project. So you need to also find out the details of this project, right? So what is the progress of this? What is the schedule of the? What is the present status of project implementation, right? Because you don't want a situation where the proposed limits to be sanctioned to this PKR company are diverted to the group company, especially because the group company is also having a an expansion project on hand. So you basically want to ensure that ensure the status of the present stages of project implementation. What is the tie up of the how the project cost of this group company expansion project is being proposed to be financed, right? What are the sources of finance you need to be watched out. So basically, the first point that you need to be give most importance in any new proposal is the credentials and track record of the promoters, right? It is a huge topic. Credit investigation is a huge topic. In the chapter on credit concepts, we'll be discussing in detail what needs to be looked into in a credit investigation. So please refer to this chapter and the findings, the ultimate findings of the findings of the credit investigation or due diligence, whatever you call it, should be satisfactory, right? So once we obtain field level positive field level inquiries from the about the borrowers of the promoters, then let us try to look into deep into the management per se, right? What is the management ability? Okay, these promoters are said to be coming from an entrepreneurial family, right? But this company doesn't have the, but this company has Mrs. Kusuma and Mrs. Meenakshi as directors. Now, I, no, this is something that happens quite often. Uh, the actual people, right? In this case, we have discussed about Mr. Mohan Kailash and Vamsi, right? The actual persons might not be the directors of the company. It happens, right? This is especially true in case of small proprietorship firms. Okay, so basically, the husband will be the actual person who will be running the business, whereas he'll be having his wife as the proprietor of this firm. So these are done for various reasons, primarily being the usually banks have or banks have some concessional rate of interest for women borrowers, or the state governments may have some incentives, some subsidies if there is a unit promoted by a woman entrepreneur. So sometimes these sort of things do happen, right? So in this case also it looks as if we don't know whether that is indeed the case, but we know that we know the business credentials of Mr. Kailash and Vamshi. So these will be the people who will be running the project. Let us assume that our inquiries have informed that our inquiries have revealed that these two people are the main people behind the project, and these are going to run the project. So we need to then focus more on the business acumen of these two persons. Now, whether we can accept these sort of other people being acting as a front, being a directors when they're actually not running the company is something a judgment call which bank can take. Okay, right? But assuming that it's okay with the bank, right? Because these sort of things do happen. Then you have to focus on the business, on the track record, on the background and track record, and the past business experience of these two main persons, right? So the next thing that you need to focus on is on the technical stuff, okay? Especially in these sort of businesses, the proposed project is an aluminum manufacturing unit where we need some technical expertise. So the promoters by themselves don't have experience in this line of activity. If you recall, these two promoters are in the business of trading of metals, okay? But they don't have any experience in the manufacturing activity. So we need to understand who is the technical team the company is going to put in. Okay, so you need to inquire about the technical team. So in this example, we are given that Mr. Panda will be the technical person. So we need to get details about the background, the qualifications, experience, and whether he is competent to handle this project of this size. Right? So what are the companies that he has worked for in the past, right? And whether he can handle a project of this size, right? So once we finish those 3 points, right, that is related to the management, we can start with the technical aspects. Okay, so the first thing that under the technical points you have to see the installed capacity. So for this project, the installed capacity is 26,250 tons per year. So what you need to do is you have to ensure that the plant and machinery proposed, right, because the project cost will be having a one of the terms land building will have one item called plant and machinery. So now this plant and machinery, right, the proposed cost of this plant and machinery should be in line with the installed capacity. For this, you need to be aware of what is the reasonable cost for various industries, right? That's where your technical officer, if you have a technical officer in your department, will that be useful? If not, you can draw references from similar companies of similar size, similar projects. Okay, so one thing very important in install capacity, the company might have an install capacity of say 26,250, but uh, a company will not utilize the entire capacity, right? Now there are some restrictions that now the company can utilize 100% capacity, but in practice what happens is the operating capacity will be less than 100%, right, due to various reasons. Now when it comes to projections, the financial projections, right, financial projections under sales, how is sales arrived? It is basically quantity into sale price. Let us focus on the quantity right now. Like, the quantity is basically a function of the capacity, right? Say for example, the company has got a capacity of 26,250. Now in the projections, if you see the projections are based on 26,250 of production and multiplied by so and so, whatever the selling rate, and the company has a red sales like this. The company is projecting sales based on production of the entire 100% utilization. Now this is something which you normally do not want that to happen, right? You normally, even not even 100%, even 90 or 95%, such a high level of operations, you will not, banks will not accept in the, especially in the first year of operations, because there will be a lot of bottlenecks, because there will be a lot of initial hurdles, right? So it's normal to be starting with, say, in the assumptions, right? You can start with a 70% or 80%, and then maybe sort of stabilize it at 85% or maybe 90%, varies. Okay, one, do not project at 100%, and two, in the initial years at least project a lower capacity utilization and accordingly arrive at the turnover, right? Because if you start at 100% and then you arrive at the turnover accordingly and the profitability accordingly, if this profitability doesn't materialize, right, because ultimately your term loan repayment is going to be made out of the profits, isn't it? The term loan repayment will be made out of the profits. Your DSCR, if you recall, DSCR is actually calculated based on profit, right? Say your DSCR say 1.60. This is based on the profits, which is arrived based on 100% capacity utilization. Now, if the company could not achieve, which is very likely, in the first year, if the company could not achieve that 100% utilization, your profits will obviously come down, and thereby your DSCR will be affected. The DSCR will be lower. Maybe it can fall below 1, we don't know. So the repayment ability of the company will be affected. So in the projections, at least make it a point, in the initial years at least, do not go for a very high capacity utilization. Start with around 70, 75, 80, right? And then you can slowly build in the coming years, okay? So the next point that we need to look on the technical aspects is the technical feasibility. Now under the chapter on term loan appraisal, we have discussed about TV report. So please recall please refer back to the chapter where we had a detailed discussion on the TV report, which is the techno-economic viability study. Okay, usually banks will be having a panel of engineers, right? So you have to get the TV study. The company has to get the TV study done by the empaneled engineer, right? In this case, the company has engaged the services of an industrial consultant. Okay, so you need to look into the credentials of this consultant. Okay, whenever you come across a TV report, this is something we have discussed earlier. Okay, so please refer back to the chapter. Broadly, what you need to do is what is the ultimate conclusion of the TV report? Whether the report has concluded that the project is technically feasible and economically reliable. Whether this consulting agency has pointed out any caveats to be looked into, and also you have to look at the credentials of the consultant. Like what are the projects for which the company for the consultant has done in the past, right? What are the scale of the projects? Has the consultant undertaken TV studies for large projects? Because the present the company, because 26,250 is a huge project. Okay, so has the consultant done TV studies for such large projects in the past? Okay, so these are the things you need to look into. So in this case, the company has appointed TechnoArt as a technical consultant. So you need to get into the credentials of the consultant, get a list of the past projects this consultancy has assisted, and what are the size of the projects, and are they comparable to the size of the present project. Okay. Now, one more thing that you need to look into from a technical point of view is the manufacturing process and technology. Usually, in some cases, it is a given, right? Usually, it is a given in the sense that there will be a preferred manufacturing process in this particular industry. Usually, that happens, right? Sometimes there might be only one standard method that is followed uniformly across the entire industry, or there will be one preferred method that is followed. So everybody does that. But in case of, for example, in the case of manufacture of aluminium, as this company is engaged in. Hall hair roll process is in the industry standard. In fact, it's the only method of smelting of aluminium currently used in the industry. So here there is no choice. But in some cases, like steel, for example, you have a choice. You can go for either say induction furnace or electric arc furnace. So whenever you have a choice of technology and the company is opting for a particular technology, you have to discuss the manufacturing process and what are the reasons for choosing this particular method over the available alternative method, right? Then you need to discuss the industry scenario in your process note. Okay, industry scenario, you can basically it gives you the idea of how the industry is basically performing, because no matter how good the promoters are, how strong the financial position of the company is, basically if the industry is not doing well, as a banker you don't want to be financing into. Look at the short term trend, say the next 1 to 2 years or 3 years, and if the outlook is not good, there's sometimes, because say for example it's not that positive, maybe you won't be getting into financing into that company. Basically, this comes from your CMRD department. Right? Banks will be having the credit monitoring department. They'll be furnishing maybe monthly guidelines as to what are the sectors, what is the outlook on particular sectors. There are some industries, there are some sectors like for example, real estate, where usually it's finance is very restrictive. You won't be getting into finance usually. Then there'll be some industries where your CMRD might be saying, like say for example this industry, this paper industry, the outlook is not good, right? So you have to be careful. It's not that you should not sanction, but the powers will vary. Maybe you have to obtain prior approval from your higher ups. You have to look into those aspects. But even if the industry scenario is favorable, still you have to comment on the industry scenario. What are the competitors? What are the growth factors of this industry? And what are the possible threats that can come to this industry, right? You have to analyze the demand position, because right, especially in the markets where the company is proposing to market. Okay, this company, a PQR, is basically trying to market its products in the southern market, right, in the southern state. So you have to analyze the demand position, especially in the southern market. What is the demand of aluminium in the southern states of India, right? Then SWOT analysis is something that is usually done. Basically, it's an assessment of the strengths, weaknesses, opportunity, and threats for this company. So what are the strengths of the company, weaknesses, right, and opportunities and threats? So whenever you have a weakness here, when you discuss the weakness, you have to provide some mitigation. It's not just enough if you just mention this is the weakness. Strengths, okay, but weakness, if you say so and so is the weakness, you have to provide how the company is proposing to overcome this weakness. So there should be some mitigation factor. For example, in this case, the weakness is the promoters themselves do not have any experience in the manufacturing activity. So what is the mitigation they are proposing? They are putting up a technical team, right, headed by Mr. Panda, who has experience, who himself is a technical man, and who can run the project. So you have to provide the mitigation. Whenever you are saying this is the weakness, you have to provide the mitigation. So basically, that's what we also do in the risk assessment. So what is an overall framework, right? We discuss the strengths, weakness, opportunity, and threat. Risk assessment basically is about what are the various risks that the project can face. So it can be funding risk, it can be a project completion risk, various risks, and then for each risk you will go on to mention the mitigation. In this case, as we have discussed, management could be a risk because they don't have a proper experience in the manufacturing. So it could be funding risk, the equity, for example. The promoter's contribution might be coming from a mix of equity and unsecured loans. So this funding could be a problem, whether the promoters can actually raise these unsecured loans proposed. Project completion risk, for example, could be another risk. So you have to look at the various risks that the project might face. Then you have to discuss also on the marketing and distribution aspects, okay, because ultimately the product has to be sold to generate revenue. So under this aspect, you will be discussing the market, what is the proposed market for which where the company is targeting sale of these products. So in this example is the southern market. You also talk about the distribution setup, right? What is the sales force? What are the storage facilities such as godowns and all? Also, all this needs to be analyzed, right? And if it's go down again, whether it's an own construction or taken on lease. And if it's on lease, again you have to look into the lease agreement, the tenure of the lease, and all things like that, right? Now, one of the most important items of the project cost, right? In project cost, we have land, buildings, plant and machinery, right? Furniture and fixtures, vehicles, and all the preliminary pre-operative expenses, everything, right? So the land is the most important, it's the starting point in the project cost. So the first facility that you need to assess is the land. So here you should be concerned about the extent and the price, right? So what is the extent of the land? So is it sufficient for the project, right, for the proposed scale of this project, right? And then you have to inquire into the land rate, because in the project cost, this land cost is arrived based on some assumed land rate. Okay, so much rupees per acre. So you need to look into whether the assumption of the land rate per acre is reasonable. Okay. Sometimes land is not purchased; it is taken on lease. So in this case, you have to look at the lease date. Okay. Usually banks, unless it is a very large project. Okay. Unless it is a very large project, usually banks prefer the land to be own land. Okay, by the company. So they don't prefer land to be leased. Okay. Uh, of course, if it's a very large project, you can accept that. Generally, it's the norm in banking industry that they prefer the land to be own land. Okay, the land, they want the promoters to purchase the land. Okay, instead of having a leased land, because when it comes to security, okay, so if the land is on lease and then the company has applied for term loan for say buildings, plant and machinery and things like that. Now, the bank will be stipulating a mortgage of buildings, but it doesn't make sense to have a mortgage on buildings without land, okay? Because ultimately, land and building, because buildings are constructed on land. So basically, banks want equal mortgage of both land and buildings, okay? They want this to happen, and this can happen only if the ownership of the land lies with the company. They can't they can't say we'll have only a mortgage on buildings and leave the land without security. So usually banks will be stipulating usually prefer the land to be own land of the company. Okay. So in this example, we are given that the cost of land is 15 lakhs, which appears to be low, but maybe it's a concessional rate because it is we are told that it's 100 kilometers from Bhubaneswar. Maybe it's a backward area. We don't know. Let us accept this is a reasonable land rate. So when it comes to land, an obvious aspect that needs to look into the location where the land is located, where this project is proposed to be set up. What are the locational advantage? Why the company has, why the promoters have chosen this particular area? What are the advantages this area has compared to say some other alternative location? So that needs to be discussed in your project note. In this case, is because of the proximity to the raw material sources. Because Orissa and Chhattisgarh have a lot of mines, so obviously this company, the promoters are setting up the project in this area. So this is a obvious reason. Then after in the project cost after land, right? The next item is buildings, right? So in the project cost, you'll be having some cost for buildings. So now you need to analyze whether it's okay or not. So for this, what we look at is the known as the civil estimate. Again, this is something which we discussed earlier in the chapter on term loan appraisal. So please refer back. What are the points that you need to look into when looking at the civil estimate? Okay. So in the process note, you need to list out the civil works proposed. Okay. So basically, the format will be a description. So this is the civil work. What is the quantity of work, right? So square meters or SFT, whatever, and what is the rate per SFT and all. Finally, you have the cost, and you add up all the cost of individual items. You end up with the cost of construction. Okay, so then you have to reproduce this table in a process note and comment on the assumed rate, whether it's reasonable or not. Right? Usually, civil estimate is prepared by an engineer impaneled by the bank. Okay, so you need to look at the justification whether these facilities are required for this project, and then what is the reasonability, what is the cost, whether the final cost is reasonable or not, and then you have to furnish your comments, right? The next item in the project cost will be plant and machinery. Again, we had a detailed discussion on plant and machinery in the chapter on term loan appraisal. So please refresh your memory. Again, here what you need to look at is for this industry, right? Is the proposed equipment and machinery required, right? So this you can get if you have a technical team in your credit department. You can take their assistance, or if you have finance similar projects, right? You can draw up a comparison. Okay. So in this example, the plant and machinery cost is estimated at 25 crores, right? And when looking at plant and machinery, you also need to look at the suppliers, whether they are reputed or not. Okay, so let us see this breakup for this company. What is the 25 crores made up of? So this is the breakup. Please zoom if you are unable to see this. If you are unable to see the figures, or you can refer to the book we have. This is in lakhs, so this is around 25 crores. Okay, so this is the individual breakup. So basically, this will be the format that the companies will be giving. This will be usually be available in the project report. Okay, so they'll have a base price and various other taxes. Finally, have the total rate. Okay, you add up all this, you have the total cost. So what you need to look at is whether for this project these items are required, and then what is is it reasonable? Is the cost reasonable? Okay. So for a project, power requirement is very important. So you need to look into what is the arrangement the company has made so far. Maybe the company power, maybe the power connection is not yet obtained because the company is still the project is still under construction. But at least usually the power board will be issuing what is known as a feasibility certificate, right? Even before supplying the connection. So banks might insist on this, right? This is like the electricity board saying, okay, it is feasible to set up to give a connection to this project at this location of the site. Okay, so you need to at least insist on the feasibility certificate, and then also in some projects you also need to have a backup arrangements, right? So generators should be included in your project cost on the plant and machinery if there is a requirement for backup power. Then availability of labor, a very important aspect in a project. Ultimately, these are the people who are going to work, especially during the construction. So you need to look into the number, right? What is the total labor required? What is the availability, whether they're locally available or not? Usually, labor will be sourced locally, okay? Unless it is very specialized labor where they need to be brought in from some particular place, but usually it will be locally available. You have to look at the labor rate per hour and see the assumption whether it's reasonable or not. Say for example, say 400 per day usually. This is the prevailing rate for construction labor. So again, you have to look into various factors and see whether look at the availability, both the availability and the cost of labor. The availability of water is also important because water is not just for human consumption, also for the sometimes the activity might be a processing activity where water might be required for say for example washing might be required for say for example washing ore, you know, where you have water. So you have to try to assess what is the total what is the total water required per day, say so and so kiloliters required per day. You have to drop this estimate. This will be provided by the company. You just try to see whether it's reasonable or not. Okay, and then try to see what are the sources of water the company is going to propose. Whether it's going to dig a borewell here or some other source of supply. Right? You need to look into. Then raw material is a very critical point in projects, for project to be successful. So what is the source? Usually companies will be locating the project at areas which are close to the raw material source. Okay, so that we discussed under the location advantages. So for this company, basically raw material for aluminum industry is bauxite. So it is available from the nearby mines in Orissa and Chhattisgarh. So for this company, it is okay. For major projects, usually banks insist on what is known as long-term linkages. It's a very large requirement. So the raw material requirement is very huge. In that case, it's better to have what are known as long-term linkages. So basically, these are agreements drawn up by the company and the mining agency. So the mining company will be promising that we are going to deliver so and so quantity of of ore to the project. Okay, so long-term linkages you might insist for a larger project. Usually, this is for larger projects. Then you need to look at the statutory approvals for any project. There will be a set of approvals need to be obtained from the government. So you have to make a list of all the statutory approvals. You have to drop a table in a process note. These are the approvals required. And what is the present status? If it is obtained, fine. If it is not obtained, at least mention the status. What is the present status? So at what stage it is, when it is expected, right? So you have to make a list of all statutory approvals. And in case anything is pending, you have to stipulate a pre-disbursement condition, because if you don't get the project report, the entire project can be put on hold. Okay, so before disbursement, so in case any approval is pending, make it a pre-disbursement condition. Right? Before disbursement of the loan, you have to ensure that that particular approval is obtained. Okay, and in particular, make a special note of the pollution control board clearance. Okay, this is a must for every project. So again, so for each project, for each approval, you have to list what is the present status. Right? If it is approved, if it is obtained, mention what is the approving authority reference number in the process note. If it's not obtained, mention the present status and when it is expected to be obtained. Okay. So any pending approvals, stipulate in the pre-disbursement condition. It will also protect you as a credit officer, because in case the disbursement happens, right? In case the disbursement happens by the branch manager without getting the approval, then you will be safe as a credit officer, because you have stipulated this as a condition. So usually as a credit officer, you should also always look at protecting yourself and also a bank. Okay, but primarily you should try to protect yourself, and this comes with strong conditions. Okay, if you find that in any proposal, not just term loan proposal, any proposal you find there are some gaps in the proposal, the way to protect yourself is to stipulate strong conditions. You can go ahead with the sanction, because you cannot stop processing the proposal in every case. There will be pressure from the higher ups, there will be pressure from your immediate boss, there will be issues like that. But at least if you cannot stop the, if the gaps are, if you're not able to convince your higher ups to stop the proposal from being processed, at least go ahead and stipulate some strong conditions. Okay. So for this company, let us assume that the inspector of practice approval is pending. Okay. We'll stipulate this in the pre-disbursement condition. Then we have to look at what is known as the implementation schedule. So implementation schedule is basically a table. So what the a table looks like is, for each activity, what is the expected completion, when it is expected to be completion. Final item will be DCCO, that is the commercial operations. But before that, each and every item, say for example, acquisition of land. So when are you going to purchase the land? When it's going to be acquired. Okay. Then construction, starting of civil constructions, completion of civil construction, ordering for plant and machinery, installation of machinery, trial runs. So each and every activity will be listing, and we will be informing what is the likely estimated completion date. So that will be giving an idea as to what is the final DCCO going to look like. Okay. And it is very normal that in the project report there will be one set of an implementation schedule. The company will be estimating so and so, and finally these are DCCO. Whereas when it comes to actual processing of the proposal, by which time there will be some time gap. Say for example, we are now here in construction. The company has said this is acquisition of land, say Jan 13. Say for example here April 13. The company has assumed that the loan will be sanctioned sometime in March, and it will start the construction in April 13. But whereas now it is already April 13. Due to various reasons, the sanction was delayed, and when you process the proposal, you found out that it's already April 13, right? And then the sanction will take time, disbursement will take time, maybe the final the disbursement will be towards the end of May. So maybe the construction will start from June, we don't know. So this needs to be revised. So it is very common that when you look at the proposal, the implementation schedule will be behind by 2 to 3 months due to various reasons. Okay, maybe the sanction could be delayed due to various reasons. Okay, so in that case, you have to insist that the implementation schedule needs to be updated. Then you need to look at what is the present stage of implementation, because company cannot say unless bank sanctions, we will not start the project implementation out of their own funds, because there's also a margin of the borrower. The borrower also has to put in some margin. So out of the promoter's own sources, they'll be starting some work, basic work. So you have to mention what is the present stage of the project implementation, how much work they have completed so far. Expected DCCO is very important because DCCO because it's linked to NPA as per RBI norms. Okay, DCCO is date of commencement of commercial operation. So every term loan proposal, the company will be mentioning in the project report what is the expected DCCO, right? So you have to be very, very careful with this date, because in case the delay is more than 6 months from the envisaged DCCO, say for example the project report says by August 2014 will start the project, the commercial operations will start, right? Say for example there's a 9-month delay and actually it started on May 15th. As per RBI norms, if the actual DCCO is delayed more than 6 months from the envisaged DCCO, the project will be classified as NPA. Right? Irrespective of whether the company is repaying the interest and installments promptly, that is immaterial. In spite of that, in spite of prompt repayment, if the actual DCCO is greater than 6 months from the envisaged DCCO, this for non-infrastructure projects, by the way, it will be classified as NPA. So you have to be very careful when fixing DCCO. At the time of sanction, right, since the financial closure happens, right, you have to spell out the DCCO very clearly, right? And that's why it's very important to conduct the pre-sanction unit visit before sanctioning. Just 1 week or 2 weeks before the sanction, you have to actually go to the site and look at what is the actual status of the project implementation. You'll get a fair idea as what are the works yet to be completed, what is the likely time the project is going to be completed. And even after sanction, during the disbursement, you have to make periodic site visits to get an idea of what is the pace at which the project is progressing. Okay, so in case you get an idea, you feel that the expected DCCO seems to be not practical, it might not be achieved, then you have to insist on revising the DCCO, right? You get a fresh DCCO. Okay. So pre-sanction unit visit is very important because it will give an idea as to what is the physical progress. Seeing in papers, company will be submitting some papers, and that is one thing, yeah. But physical inspection is totally different, right? You'll get an idea as to what is the actual progress of the project, and your DCCO should be fixed accordingly, right? Your DCCO should be fixed accordingly based to the physical progress of the project. Then we said that even before the bank sanction, the company will be starting the work based on its own funds. Okay. before the sanction comes. So how much what are the works that are completed, you will make a note in the process, and also what is the amount spent, right? What are the works that are spent and what is the amount, how much you spent. This amount may be backed by a certification from a chartered accountant, right? So this will give a comfort level to the banker, like, okay, right, the promoters have invested so much money out of their own funds, okay? So this is something you can insist. Then you need to, the fundamental part of any project report is the project cost. So we have discussed what is the breakup of project cost in a chapter on turnover appraisal. For this company, this is the breakup of the project cost. Okay, so it's total is around 55 crores, and this is the breakup. The major portion seems to be plant and machinery, okay, and civil works. Okay, this is also an item on preliminary pre-operative expenses. Okay, so please refer back to the chapter on turnover appraisal, where we have discussed each and every item of project cost. So what are the aspects that you need to look into? So that is a very important chapter, right? So to get an idea, what are the points that you need to look into each and every point when assessing the reasonability of project cost. Okay, for this company, let us assume this is reasonable, and then associated with project cost obviously is means of finance. So out of the 55 crores, the promoters are going to contribute around 20 crores, and bank will be sanctioning the promoters are requesting a term loan of 35 crores. Okay. So once we have an idea of the project cost and the means of finance, you have to calculate what is the eligibility. Just because the project cost is 55 crores and the company is asking give us 35 crores, we'll bring in 25. It doesn't mean you're going to sanction 35 crores. You have to see whether the company is eligible for this loan of 35 crores as per your bank policy guidance, because each item will be having what is known as a margin, and this margin will be varying from item to item, and it varies from bank to bank. Say for example, land and building might be stipulated to say 40% by one bank. Some bank might be saying we'll stipulate a margin of just 30%. So it varies, right? So you have to look into your bank's policy guidelines and try to calculate what is the a margin. Okay, let us assume for this bank and this company, for this bank this is the stipulated margin. Land is 40%, site development buildings all is 40%, plant and machinery is 25%, electrical line and fixed assets, miscellaneous fixed assets is 40%. Rest of all bank is not going to finance, 100% margin. So in the chapter on term loan appraisal, we have seen how to calculate the term loan eligibility. Basically, look at the margin, say it's 40%, which means bank can sanction up to 60%. So 0.15 into 60. This is the maximum amount of the bank can finance. So 0.09. So you work out for each and every item. This is 75% into 25.54 will be 75.75 into 25.54 will be 19.5. So for each item you calculate the eligibility and you will arrive at what is the total eligibility. So in this company, in this case the company is asking for a term loan of 35 crores, whereas the actual eligibility is only 27.63 crores. So one thing you have to note that sometimes banks do finance a part of this these items also, not marginal working capital, but preliminary pre-operative expenses, interest during construction. Sometimes banks do finance up to 50%. Depends again on the policy guidelines. So this might go up, right? We don't know, right? Or alternatively, bank might still sanction 35 crores even though the eligibility is 27 crores. For that, maybe the competent authority might seek approval from a higher authority, right, to permit the deviation. So these sort of things are allowed as per the bank policy guidelines. Okay. So, but in case it is not happened but in case the bank is not favorable to sanction more than this, what in that case, borrowers have to bring the balance 35 crores minus 2763, whatever is the balance, the shortfall, they have to bring it as the margin in addition to the 20 crores their own margin. Right? So the total project cost is 55 crores. Originally they thought bank will give 35 crores, we will bring in 20 crores, but now bank is giving only 27.63 crores. So the balance 7.37 and the original 20 crores put together, this 27.37 the promoter should be bringing in case the bank is insisting that we will sanction only up to this amount. Okay. Then we need to look at the drawdown date schedule. You have to mention this in your process note. Drawdown schedule, basically the company plan to how much it is going to draw, right? Because this will be linked to the physical, the proposed implementation, the project implementation. The project implementation will be based on so and so months, okay, 6 months or 9 months. So accordingly, the draw will be happen. It's not like the bank will give 35 crores term loan today and the company will be drawing the entire 35 crores today. Okay, it's not going to happen like that, because the disbursement will be in phases, right, based on the actual progress of the work. So this is the likely drawdown the company is proposing, right? This you have to match with the project implementation. Okay. Then as for term loans, you have to obviously stipulate what is the repayment period and the holiday period. Now company will be asking, we want say repayment of say 7 years. We'll repay in 7 years, and we require a holiday period of 1 year. Company will be asking anything, and they'll be preparing the projections accordingly. You have to see whether it conforms with the policy guidelines. Usually banks will be having what is the maximum repayment that they can allow. Some banks will be saying we cannot repay, we will not allow more than 5 years. Some say 7 years, 8 years. So look into the policy guidelines and see whether the what the company is asking is acceptable to the bank. Okay. And regarding the moratorium period basically is to give time to the company to start repayment, because it's not like it cannot happen like the sanction happens in May and from June 2014 you start the repayment. It cannot happen because the project will be taking time to implement. Okay. Basically, what is the term loan for? Term loan is for land, building, plant and machinery. So the project implementation itself will take time, say 6 to 9 months. So immediately you sanction on me and ask for repayment from June, the company will not have funds to repay because the project is still on the implementation stage. So you look at the DCCO, what is the estimated DCCO, and accordingly fix the holiday period, right? And give some, even after DCCO, give some time, say 3 months, and then you can start the repayment. Okay. Because if you are very aggressive in stipulating a very early repayment period, you will end up having a risk of NPA, right? Because if you don't take into account the DCCO, if you don't take into account the DCCO, what is the likely project completion time, and you stipulate an early repayment, the project might become an NPA. Okay, so you have to take into account the implementation schedule of the company to fix the appropriate repayment structure. Then in assumptions, the entire projections, the financial projections of P&L, projected balance sheet, entirely is based on some assumptions. Okay, basically these projections are based on basically these are just figures in the future, right? The company we saying will achieve so and so sales, will achieve so and so profit, right? It's telling some projections. All these projections are basically assumptions. So what are the assumptions based on which the projected statements are prepared? This is very important. In fact, when you get a project report, the first thing that you have to go is the assumption sheet, right? This is the first thing, because everything in the project flows from these assumptions. If the assumptions are not satisfactory, right, then you need not look into the financial projections, because the projections are prepared based on the assumptions. Say for example, the prevailing rate, steel rate is around say 45,000 per ton, the selling rate, whereas the company has taken 60,000 per ton in the projections and prepared the projections accordingly, and accordingly it is prepared the sales, it is prepared the profit. These are basically wrong projections. You can't have so much variation between the actual sale price and the projected sale price, because once you accept this, everything will look fine. It looks like the company is going to make a good turnover, is going to make a good profit, when actually it might not be the case. So the first thing that you need to look at the project report is the assumptions, right? So in your process note, you should always list the key assumptions, right? Because company will always prepare projections in such a way so as to arrive at a comfortable profit, comfortable current ratio, comfortable TLP, and they will manipulate the assumptions so as to get a version that is compatible with the bank's policy norms. Okay, so please question each and every assumption, right? If you're not satisfied, please insist on revising the projections, ask the company to get a new set of projections. Okay, so for this company PQR, let us assume these are the assumptions that the company has taken. Okay, so capacity utilization is 75% in the first year and 85% in the second year, and 90% thereof is okay. A number of operations is 350. Sale price is 51,000 and 30,000. So again, you have to look at what is the prevailing market rate and what is the cost of raw material for this. So you have to know what is the cost of bauxite per ton, or to look at what is the cost of aluminium per ton. Okay, this you can get from some industry journals. Set consumption 2.5 tons. This is assumption 2.5 tons per MT of aluminium output. Seems to be on a lower level because the industry average is around 4 to 5 tons. Right? So this might be lower. We need to check into this. Power cost again looks to be low, isn't it? 4 usually for industrial borrowers it's around 6. So maybe this is on a lower side. You need to question that. Rest of them are repairs and maintenance, 0.5% fixed assets, consumables, wages, administrative expenses, tax rate, depreciation. All this seems to be okay. Loan disbursement, DCCO, rate of interest, holding levels, again raw material seems to be in a higher side, 4 months. You go to the list, you go through the list of assumptions and see if anything stands out. If any assumption is not, if you're not comfortable with any assumptions, then you can have a discussion with the company. It's not that you're going to reject it outright, but it is going to inquire with the company what is the basis for the assumption. And then if you are convinced, that's fine. If not, you can ask for a revised set of projections. So then you will look at once you're satisfied with the assumptions, then you can look at the profitability statement, balance sheet, and the cash flow statements, right? So once the assumptions are fine, this should be okay, right? Once the assumptions are fine, rest of things should be uh, this should be okay, right? Again, look into anything that stands out, you're not comfortable, you can inquire with the company for clarification. So let us assume that this is the projected balance sheet for the company, starting from the construction period and up to the closure of term loan. So if you look at the term loan from bank, it's starting at 35 crores. Is the loan that the company is applied. Slowly it's coming down to zero, right? So look at all the items. If you find anything that is uh, if you find anything that you are not comfortable, you can ask for clarification from the company. So one thing that you might watch out is so for this company everything seems to be okay. Okay, maybe one thing you can ask is the share capital. If you remember, the project cost of around 55 crores is going to be financed by term loan of 35 crores and margin of 20 crores. If you look at this column, the term loan, the entire term loan of 35 crores is drawn, whereas the margin is only 16 crores. Entire 20 crores, that is 19.79 to be precise. That entire margin, the 19.79 crores is projected to be coming in from next year, whereas during the construction is not shown. So why, you might ask? So in this case, it is acceptable because that difference is actually margin for working capital. So margin for working capital will be coming once the production starts. So maybe not during the construction period. Okay, once the production starts, commercial operations begin, that margin will be brought in. So in this case, it could be accepted. Then there is some short-term borrowings here. There is a CC limit. Okay. I think everything is okay. Cash and bank balance. If you recall, discussion cash and bank balance. We had a discussion on this working capital assessment chapter. Okay, this can't be so high. The company is asking for a working capital limit of 10% having such a high cash balance projection. This is not acceptable, right? This needs to be revised. Receivables, absolute figures we cannot comment. We need to look at the holding levels. Okay, everything is okay. Look at the gross block is increasing every year. This can't be the case, right? So 50.11 is the base gross block, but every year 2 crores is increasing. You need to question this. Usually what happens is, I'll tell you why it happens. Okay, usually if the profit is very high, that excess profit will be placed either in cash or in fixed block. Okay, this we'll discuss later. So rest of things are okay. So look, have a overall look at the projected balance sheet in the P&L account. So you'll get an idea as to any item is standing out. If you're not comfortable, you can get clarification on the company. Okay. So I think basically that's what we are summarizing here. Margin. This I already told you that 19.79 crores is appearing from 2014. It's not appearing from during the construction period because that's a marginal working capital. That's okay. Holding levels and all we have discussed. It looks like the raw material holding level is around 4 months. This is higher. You need to inquire why the company is projecting so much high level of raw material. Cash bank balance, I told you we had a discussion on this during the chapter on working capital assessment. For 10 crores of working capital, the projected cash balance is very high. You cannot accept this. Okay. So we've seen that the gross block is increasing every year 2 crores. So basically what has happened is to arrive at a DSCR of comfortable DSCR of greater than 1.50, the company has assumed certain profit. Okay, so that profit seems to be very high, and what's happening is that in the liability side, in the balance sheet we have liabilities and assets. Okay, so high profit is going to result in high reserves and surplus because that profit will be retained profit will be going into reserves and surplus. So the liability side is increasing. So to compensate this, to balance the balance sheet, the auditors of this company, what they've done, they have to put this that extra amount somewhere under the asset side. Okay, so they have put it on the cash in and partly in fixed assets. So that's why you're finding cash is very high and fixed assets is increasing by 2 crores every year. So this is a common practice by auditors. You need to watch out for. They will say they will justify by saying the company is having so much profits, will have it's okay to have a large cash balance, but that is not acceptable because if you have so much cash balance, you do not require 10 crores of CC. Right? If really you are going to get that much profit, you can tone down your CC limit. Okay, so this is something you need to watch out for. And this is something we should discussed earlier. Okay, so let's not go into too much depth into it. So security and margin is something you have to calculate. We discussed something called asset coverage ratio. If you recall, in the chapter on term loan appraisal, you need to calculate this ratio and including your process note. Okay, DSCR again. Please refer back to the chapter on term loan appraisal. We are not going to discuss what is DSCR, what is the calculation. We had an in-depth discussion on that. For this company, we are calculating DSCR as 1.64. This is greater than 1.50, the benchmark norm. You have to check two things, not just the overall DSCR greater than 1.50, you should also see any individual year the DSCR is less than 1, right? So in every year DSCR is greater than 1, so that's okay. Sometimes what happens is is that the overall DSCR will be above the benchmark now, but whereas in some year, especially during the initial years, it will be less than 1, say 0.85. Basically, what the company is saying is we cannot, our profits will not be sufficient to repay the bank loan in this year. That's why you're having a less than 1. DSCR less than 1 basically means that, right? Your profits are not going to be sufficient to repay the interest and the installment. So that's not acceptable, right? If that is the case, either you have to stipulate a lower installment during that year, or you have to find out, you have to insist the company brings in funds from outside to repay somehow, right? You can't accept that sort of a scenario. So look at the overall DSCR and also DSCR during the individual years. Okay, in no year it should be less than 1. Then you can also calculate the sensitivity. You can also do the sensitivity analysis. Sensitivity analysis is for large projects usually. Some cutoff, say term loans greater than 1 crore. It varies from bank to bank. Okay, greater than 2 crores. They'll be conducting what is known as a sensitivity analysis. We have done this already in the chapter on term loan appraisal. So please refer back to sensitivity analysis. For this company, power seems to be a very important cost. Okay, so try to do the sensitivity analysis. What happens? The assumed rate is 4 per unit. What happens if it is 5 or 6? How will the DSR be affected? You have to see. Okay. Besides this, you have to do DSCR. You have to do sensitivity analysis for regular change in sales price, say 10% or 5% change in raw material cost. Okay. So in every case scenario, DSCR should be less than 1. For sensitivity analysis, DSCR need not be greater than 1.50. Okay. But at least it should be greater than 1 for all years. Okay. Base case DSCR should be greater than 1.50. Right. But in sensitivity analysis, say scenario 1, scenario 2, scenario 3, right? Because we are looking at adverse scenarios, it's okay for DSCR to be less than 1.5, but definitely it should be greater than 1. In no case it should be less than 1. So next break-even point. Again, we discussed this in depth during the chapter on term loan appraisal. So for this company, we can calculate break-even sales like this. Basically, break-even point is you have to segregate the cost into variable costs and fixed costs, right? So if you recall, we discussed something called contribution. Contribution is contribution is sales. What is this? What is the sale minus your variable cost, right? So your break-even sales will be, so your break-even point will be a fixed cost by the contribution, right? This we discussed. So you can calculate the break-even point for this company. The break-even sales, the operating capacity is around this. The assumed operating capacity, if you recall, capacity utilization is around 75% something. So it is greater than the break-even operating capacity. So this seems to be okay. Then you can also calculate IRR. Though I should point out that not many banks are comfortable with IRR. IRR is basically one of the concepts that uses the discounted cash flow analysis. Ultimately, the calculation could turn out cumbersome. You can try it out in Excel actually. Right? Excel has a function on IRR. Ultimately, what you should see is the IRR. So so we had a discussion on IRR also. Basically, IRR is the rate, right? It's also known as the hurdle rate, right? It is the rate at which the NPV becomes 0, right? So usually you can calculate IRR, and the IRR should be greater than what is known as the cost of capital of the company, right? So this is a topic in financial management. Not many banks calculate IRR, but basically it's an advanced concept. But you can ultimately check whether this is greater than cost of capital. Now, where are you going to get the cost of capital of the company is again an issue. That's an issue, but at least have a say around 50%, right? As long as it's greater than 15%, it should be fine. Okay. Basically, weighted average cost of capital is it's like company will be having various sources of finance. Okay, it will be having funds from the promoters, reserves and surplus, your term loans from banks. So various people will be contributing to the finance of the company, and each one will be having a cost. Okay, say for the term loan, the bank is charging a rate of 15%. Equity and reserve surplus, you might think that it is 0% because it is promoters fund, but it's not actually 0% because there is an opportunity cost here. The promoters are foregoing some opportunity. Instead of investing elsewhere, they are investing in this company. Had they invested elsewhere, they would have got something, right? So let us assume they would have got say 20% there. So that should be a cost here because it's an opportunity cost. Okay. So then you have to wait. Say out of the total 100%, the promoters have pumped in 20%, retained earnings are around 10%, and bank has sanctioned 70%. Then you have to do a weighted cost, right? 20% because we're assuming 20% for capital and reserves in the plus. 15% is the rate of interest of banks. Then you have to do a weighted average, and then you'll arrive at what is known as the weighted average cost of capital. For this company, it will be around between 15 to 20%, obviously, right? So that will be the weighted, say for example, 17%. So you calculate that as the weighted average cost of capital. Then you compare that with the IRR. Your IRR should always be greater than your weighted average cost of capital. Okay, might be an advanced topic, but Excel will, but actually Excel has got a function to calculate IRR. So, then you can look at the special pre-disbursement conditions, right? Banks will be having a standard set of terms and conditions. So every process note will be, you will be copying paste the as a credit officer, you will be copying paste the standard set of conditions. But each proposal is a special case. So apart from the standard terms and conditions, you also need to stipulate some special conditions for this particular project, because each project will be having its own lacuna, right? You need to address them. For this company, for example, we've seen that the inspector of factories clearance is not yet approved, so you stipulate as a pre-disbursement condition. This company also has got a group company, so you have to obtain satisfactory PNC report from the bankers of the group company. So for each proposal, there will be separate set of special conditions that this is on a case-to-case basis. Okay, so if it's a very critical sort of condition, you can stipulate as a pre-disbursement condition. Only after that is complied with, you are going to release the loan. Okay. And once the loan is sanctioned, it's not like the monitoring process is over. In fact, the monitoring process begins once the sanction is done. So we discussed we discussed this point during in the chapter on term loan appraisal. If the sanction is done and the disbursement happens in phases, right? You have to, what are the points you need to look into? We have already discussed. Okay, and also because loan is to be very carefully monitored, right? Because account can go bad if it's not monitored properly, because the progress of the project will be say for example 20% or 30%, whereas the actual drawdown, say 70% of the loan might be drawn. So you don't want this sort of situation. You want this to be correlated. The disbursement in phases should be happening as per the progress of the work. You don't want somebody to be inspecting and seeing that the project is not going as per the is not going well. The progress is not as per the expected schedule, whereas the disbursement is happening at a very high rate. You don't want this. This you can address by having a periodic site inspections. Please refer back to the chapter on terminal appraisal where we had a further detailed discussion on the monitoring process. Okay, so this brings us to the end of this chapter. This is the case study on the term loan for a fresh project. Okay, so in the next case study, what we'll do is we'll take again term loan, but this time the company is not applying for a fresh term loan. Okay, this company has taken a term loan in the past year, say in 2011. The company has already taken a term loan. We have sanctioned. And now in 2012, the company has come for, say, working capital limit. Okay, now your focus should not be only on working capital limit. You should now go back to the last year's sanction and see how the company has utilized the sanctioned term loan amount. Whether the loan was fully disbursed, whether the margin was fully brought in, whether the project was completed, whether there are any pending issues. So we are going to do those sort of things. We are going to look in the next chapter. Okay, so see you then.